Okay, welcome everybody. We'll go ahead and kick this off. My name is Brandon Wendell. I'm a chartered market technician, which means I spend a lot of time studying the markets and charting and know all these different ways of analyzing the markets. Funny thing is I use very little of it because I try to keep my trading relatively simple. Simple is not always easy, but simple does work and allows you to find out better opportunities in the market. So I want to welcome everybody here. If you got any questions, go ahead and ask away. Obviously, we want to keep them to the subject I'm talking about, but obviously, if you got questions outside of that scope, you can go ahead and ask, and I'll answer them when I can. Excuse me. Um, okay. Sorry, I was just checking something out here. Just before we get started, I want to remind you that I'm just an educator. I'm not a registered broker-dealer or investment advisor, so I'm going to look at different securities with you today, but I'm doing it from an educational standpoint, which means I'm not giving any personalized recommendations or telling you to buy, sell, or hold any particular securities. Keep in mind, there's always risk involved in the markets. You can never eliminate the risk, especially when we're dealing with news. There's always a lot of risk. And we do what we can to minimize it, but we can never eliminate it. And I'm also not subject to trading restrictions, so I can have a position in a security or initiate one at any time. So that being said, let's jump into our topic today. We're going to talk a little bit about trading when there's news coming out. And I definitely want to start off by saying that it's very dangerous to trade Forex when news is coming out. And I typically, I trade futures as well as Forex. Typically when I'm trading Forex, I'm doing it on a much larger time frame. So I'm looking at weekly and at least daily, if not weekly charts, and looking for long-term moves in the currency markets. Because the nice thing about the Forex market is it has the longest running trends compared to other securities. So the trends may last, as you can see here on the euro, months. And that enables you to take advantage of long-term moves, taking fewer trades and getting more profits per trade. But don't discount day trading when it comes to trading in the markets. There are definitely opportunities there to be taken in the short term, especially because news can cause big, violent moves, which is both good and bad for traders, obviously. So, yeah, I'm just taking a look at a few things here, get set up. Like I said, I'm monitoring the Q&A in the chat as well, so if you got any questions, let me know. But basically, I use a couple different sources when it comes to news. And let's see, since we're here with FX Street, I'll be honest, I haven't really used their economic calendar for a little while, but you can see on the economic calendar, that's funny, popped up that, hey, I'm talking live today. But you got the economic calendar right here. So let me close that out there. We already know we're here. Anyway, but you can see the economic calendar goes out way in advance. So a lot of the information that's going to impact the Forex market, you've got it on a calendar. You know it's going to happen. Now, there are other news items, obviously, that are not on this calendar, and some of those can be considered to be what we call black swan events, where we weren't expecting them. They impact the market in a major way, and again, they just weren't expected. Things like the SVB, the banking issues that's going on right now, and Credit Suisse. So those obviously will impact certain securities and certain markets. You also need to understand which securities are going to be impacted. Now, obviously, let me enlarge this a little more. When we look at the news, you can see it has a flag in the name of the currency that's most likely to be impacted. But sometimes you got to think outside the box because it's not always that currency that's going to be impacted. And I'm noticing, let's see here, 1030, there it is, crude oil stocks. So when you look at stuff like this, crude oil, yeah, it says, and by the way, you can click on these to get more detail about the news itself and how it may impact, but it doesn't just impact the US dollar. You got to figure out, okay, what else besides the US dollar has a big impact from crude oil? And one of the things that I use to, again, I do both futures and Forex trading. The futures contracts on the Forex markets, they move identical. So, but whatever's going to affect the currency will also obviously affect the futures contract on that currency. So a website that I like to use is MRCI. Now, there's a paid section, excuse me, and then there's this kind of a backdoor way of getting in, if you will. So I'll copy this down for you and put it into the chat. Actually, I got to change one thing, HTM. There you go. So that link will get you to this page, and this is a correlation page for the futures. As I mentioned, it's not for Forex, but they move very similar, if not identical. So this brings you to a 180-day correlation, and we were just looking at the news that will be coming out tomorrow on crude oil in the United States. Well, if we take a look at the crude oil contract, it's right here, CL. And by the way, if you hover over the names or the, what are they called now? Geez, I just remembered. I forgot the abbreviations or the contract names, symbols. Geez, I can't believe I forgot that. Anyway, I haven't finished my first cup of coffee yet. But if you hover over the symbols here, it'll tell you what the contract is and which month you're looking at, okay? So here we have crude oil, and we can go across in that row, and you'll see that we come to the euro, Swissy, Japanese yen, Canadian dollar, British pound, Australian dollar, and US dollar. So we're trying to figure out which currencies are most likely to be impacted. Be careful, by the way. You see there's an EU, which is euro, and it says FX, and then there's ED, which is a little different. The ED, they have little blue pills to figure it. No, I'm just kidding. ED, that's euro dollars. That is actually US dollars deposited in European banks. So they created an index based on the number of money that's deposited. So that is not the currency. Okay, if you're looking for the euro, it's the Forex one right there, the EU. So anyway, looking at the relationships, you see Swissy has a negative 29% relationship, negative 28 for the euro, negative 2 for the yen, and then you get to Canadian dollar here and you see 72% positive correlation between the Canadian dollar and crude oil. Well, it's not the best correlation. The higher correlations, 90% or greater, get a green background. If they move inverse in the opposite direction, they get a negative and a red background if they're below negative 90. Okay, so those are the best correlations, and you can see the US dollar has quite a few negative correlations, obviously with the euro, but also with the Swissy, the yen, and the pound, and gold right now. However, with crude oil, the relationship is a little off. It's not really that direct. As a matter of fact, the closer you are to zero, the less impact that has, the less of a relationship you have. So typically below 15 or above negative 15 is almost no correlation, meaning, you could invest in both of those and they're not really related to each other. So we could see that obviously the loonie has a big correlation with crude oil. Well, one of the things you got to realize about some of the news items is that you can get a little sneak peek, especially with crude oil. And, anything that we can get a sneak peek on is obviously going to help us. We get a head start, if you will, on what's likely to happen with that news. So again, you can get the news right here. This is one of the places you can go. I have a couple of different websites I go to visit and see the news coming out, but this is good. Another one, I'm not sure that, well, there might be some correlations with currencies. If we scroll down a little more, I'm sorry, the currencies are up here. Say, for instance, we go to the euro and again, go across on that euro row. Keep going to the end here, and we get to agriculture. So, for instance, live cattle has a positive correlation, not huge. Actually, this is better, wheat. Apparently, the price of wheat in the United States has a negative 80% correlation with the euro. They move in opposite directions almost 80% of the time. So if there's negative news or positive news affecting wheat in the United States, it'll do the exact opposite potentially on the euro. Well, if you're not familiar, in order to get news on the euro, let's see, and move something out of the way, there we go. You can go to USDA.gov. Yeah, because you're not going to see those typically on the economic calendars. So in the USDA.gov, I believe it's under media, agency reports, I think it's there. Yes, it is. And you can go ahead and look forward, or if you do a date back, for instance, if we do, we'll do 03, and they do it the American style, 01, 2023 to today. Now you can see we can look back and see when there was news. And one of the things you want to do is if you're trading a particular currency is always go back and see how did the news affect it in the past, both positively and negatively. That way you get a little bit of an idea of what might happen when the news does come out. So for instance, if we're looking at wheat, we'd have to look for anything with wheat, feed grains, no. There we go, wheat data. So on the 9th, we had some wheat data. Okay, and I'm not sure, I think you can click on it and see the actual report. And honestly, it's not really that exciting. You know, government reports, it's kind of a cure for insomnia. So you can read the reports if you really want to. But that was at 3 p.m. on the 9th. Now, the commodity itself may not be open for trading when the news comes out. However, the euro is. And remember, the euro has a negative 80% correlation. So if we go back to the currency, go back to, well, we need to go smaller time frame. We're not going to see it on a weekly chart. But if we go back to March 9th, there we go, March 9th. And again, it was at 3 p.m. Eastern. Doesn't look like there was much of an impact there. Nope, a little back further. Here we are, 1500, and not really. Just had a little bit of a turn to the downside and then rallied again. So sometimes you'll have big impact, sometimes you will not. Okay, and obviously the impact was very muted, possibly because wheat was closed as well. However, we know, as I was saying, that tomorrow we have crude oil news coming out. And where was it? Wednesday, 10:30 Eastern. Oh, this is on GMT time, aren't I? Yeah. So I got to change it to my local time. I almost forgot. And I should be -4 today. There we are. U.S. Eastern. I'm in Florida, South Florida, Fort Lauderdale. So anyway, March 22nd, it'll be 10:30 my time. There it is, stocks. Now that's the EIA number. The one thing I wanted to mention, and I kind of mentioned it already, is that you can get a little head start on that news because there are two numbers that come out. This is the government number, the official government report from the EIA. However, if you go to oilprice.com, there is another report that comes out today at, I believe it's 4 p.m. So you would go to breaking news, and it's not there right now because obviously it's too early. But if we were to go to last week, let's see, what was the date? Come on, would have been the 14th. So if I go back, and I might have to go back quite a bit here, let's see. 15th, 14th, 1142, pretty close. There it is, crude oil inventories take a tumble. So I click on that, and you'll see this is the API, or American Petroleum Institute number. And that comes out the night before the official U.S. data comes out. So it's good to know these things. If you can get a head start on it, obviously you got a better idea of what's likely to happen. So as said, crude oil inventories build, but products take a tumble. Okay, so crude oil inventories rose with a 1.15 million barrel build, meaning they had inventory in excess of what they had expected by 1.15. So when you look at the actual number from last week, and let's see, just trying to remember on this one, if you could see the previous data. Not sure if there's a way to do that, to look at the previous numbers here. I actually also use another website, which is Forex Factory. I'm a little more used to, but I've used both, as I said. Anyway, if I go back to that day, here we are on the 14th. Where is it? March 14th. And I'm looking for the data here, CPI, current account, unemployment. What the heck? Is that showing me the crude oil? Oh, I'm sorry, that's right, because it was the next day. It was Wednesday the 15th, my bad. It doesn't show you the API number. It only shows you the EIA number. So here you have the EIA number that's set the next day, and you can see that the expectation was for 1.3. They actually had a little more of a build at 1.6 million. You can actually click here to see the previous numbers What happens when the number is better than expected? Meaning there's less inventory that should cause the US dollar to rally and crude oil to drop. And I know that again because of the MRCI correlations. Or if the number is higher than expected, that should cause crude oil to rally. I'm sorry, other way around. It should cause, if there's too much inventory, that should cause crude oil to drop and the US dollar to actually rally. So anyway, understanding that what you can do is go back to those dates and see how did this impact the news? What was the movement? So that wasn't really much of a move, honestly, because it was pretty close to expectation. However, March 8th was a little bit bigger. You can see they were expecting a build and they got a negative. So if there's less inventory, there's more demand for crude oil. That should cause crude oil prices to go up. And remember, Canadian dollar has a positive correlation, so that too should rally. So if we go, actually it's going to show as USD CAD. And you got to remember, we're looking at the inverse here. So if we go back to the 8th of March 9th, March 8th, there we go. 10:30 in the morning. And honestly, this one didn't have a huge impact. There was more movement earlier than during the news right here at 10:30. Right there. Although there was a little bit of a spike, a little bit of volatility. Actually, if I drop down to a 5-minute chart, you see more of the volatility. Of course, it takes me all the way back here. And good morning, Sunil. Hello. So it seems a little bit more of a reaction. As you can see, when the news came out, dropped the dollar, which was rising for the CAD. Remember, we had less inventory, so both crude oil and the loonie should be going up in value. Since this is the quote currency, the US dollar is the base, the dollar went down, the chart went down. Okay. Unfortunately, it didn't really move much. So, and one of the major things you really got to be careful of with currencies, again, this is one of the drawbacks at times, is that when there's big news coming out, often the spreads will widen. Okay. And if you've ever been trading during a news event, you've noticed this. It also happens when there's very light trading going on, typically between the slow hours. That would be between 4 and 6 p.m. Eastern. Again, I'm using my time where I live, but you could be adjust them for where you are. But between 4 p.m. and 6 p.m., you don't really have any major markets open until you get Auckland and Sydney opening. So therefore, with light volume, you'll also see spreads typically widen. And it's just more risk for the market makers and the brokers, so they widen the spreads. Especially during news, there's also more volatility, more danger. So if the spread widens too much, it's not worthwhile taking the position, obviously. We got to practice safety. We got to protect our money. So that's one of the reasons why I favor futures sometimes over the Forex. I do both, as I said, but with the futures, the spreads are much narrower. They don't tend to widen during the news events. Whereas with Forex, you just got to be aware it's going to happen. And there are other ways of controlling your risk. I've mentioned this before in certain workshops with you guys, but when it comes to risk management, you can really boil it down to 3 ways of controlling risk. Number 1 is size. That's probably the most important. You can choose micro lots or mini or standard. Right? You get to choose what size you wish to trade. Let me change this a little bit here. So you can choose micro, minis, or standards. If you're typically trading in standard lots, maybe you jump down to mini or even micro lots to protect yourself. You reduce your risk or cut back on your size. If you're normally doing 5, 10, 15 lots, maybe you cut it back a little bit. And that way you reduce your risk because you're having greater risk because of the news coming out. Number 2, duration. That's the length of the trade. How long will you be in the trade? Time is money. The longer you are in a position, the more risk you are exposing yourself to. Price can only move so far within a small period of time. It can move much further in a larger period. So this is really kind of a function of your chart. If you use a smaller time frame, you typically have less risk for several reasons. Your stops will be closer. However, your targets will usually be closer as well. If you use a larger time frame chart, you typically have more risk because your stops are further away, and you should hopefully have further away targets. If you're finding that you're not, that's not good. You want to always increase your reward should you be increasing your risk. And you'll find they're connected. So if you're trying to increase your reward, you will automatically increase your risk. But again, you can adjust other factors. The last one, by the way, is frequency. And that is the number of trades. The less selective you are with your trading, the more trades you take, the more risk you have in taking a bad trade. It's pretty simple, right? So we want to make sure that we take the proper trades that we are feeling comfortable with. Again, if we want to take more trades, say during news events, well, we have to adjust our risk by dialing down. I treat it kind of like a radio. If you remember the old radios before digital, analog radios had dials on them. And you would turn the volume down, that's your size, or you can change the duration of how long you're listening to reduce your risk. That would be the number of trades you take. So if we're increasing our frequency of trades, trading more and trading during news, we need to adjust our risk down on one of the other factors to keep our risk in a comfortable level. We got to be comfortable with music playing, so to speak. So that's one of the things that we can do is, again, choose the number of contracts or the type of contracts or the length of the trade. We can drop down to small time frames. Again, you're going to have a bit of a problem when it comes to the spread. You always got to account for that spread widening during the news event. After the news is out, the spreads will return to normal after a small period of time in the volatility. Okay, and you can also even see volume as well. It shows it here. I'm not sure if it will on this one or not. You got to remember though, whenever you look at volume in Forex, you're only looking at the volume for that particular broker. You can see just before that news was released, there was an increase in volume. News out, volume declines. And that's pretty typical. So I can't show the spread unless I actually look at the two different charts of the bid versus the ask. But that would actually show you, again, the spread widening as well. Actually, I'm wondering if I could do it as an overlay. I'm not positive, but I could try it. I think that's the ask. Let's try it. Edit symbols. It's going to show. And maybe I didn't do it right. So I'm not seeing it. Try it again. Maybe in a different pane. Or new pane. Nope, it's just not doing it. Oh well. Anyway, I was hoping to get the two charts side by side so you could actually see the price difference between the two. Maybe if I went to a line chart, it might have shown it differently. But it doesn't seem to be for some reason. I don't know why. Added symbols, yes. Same percents. Nope, it's not doing it. Weird. Oh well. Get rid of that, go back to where it was. Anyway, you get the idea. You know if you've been trading again, there is a difference in the spread. Oh, I got to change the scale again. I'll just change the security. Actually, no, I need this because we were talking about crude oil. And again, you some days will get a bigger move than others. Back to where we were. Change the scale. Oops, there we go. Back to regular. There we go. Anyway, so as I was saying, again, we can try to compensate for the risk by using smaller size or the frequency of trades or the duration of the trades. We go to a smaller time frame. So the way I usually look at news, again, with crude oil, I can actually get an idea of what's going to happen before it happens sometimes because we do have that crude oil inventory number that comes out for the API. And that's really one of the few that actually has the information ahead of time. So when I go back to our calendar and look at today, that was tomorrow, so for today, it looks like we don't really have much coming out anymore. We did have, and by the way, you can see with the yellow versus orange versus red, that's the impact that should have on the security itself. So for instance, this morning at 8:30, excuse me, we had consumer price core, which should have a pretty good impact on the loonie. And that was at 8:30 my time. So when I go to 8:30, a little bit of a spike. Not a whole lot of movement there again. So just because it says there will be movement doesn't mean there's necessarily going to be a large move. And there's the news move right there at 8:30. Typically what I will do before the news comes out, and I wish we had one coming out now, but we just don't. There's not really anything happening. You got bond auctions. It's kind of boring. Doesn't really have much of a move. But the way I typically trade news is I'm a little aggressive with it. And again, because you get aggressive when trading the news, you got to compensate for the risk by doing something else, dialing back the size or the duration. I do a little bit of both. When I trade news, I typically do it on 5-minute charts. I mean, you can do it on smaller time frame if you really choose to, but I typically do it on 5-minute charts. And what will normally happen when news comes out is that you'll see a basing or kind of a quieting of price action just before the news. This doesn't always happen, by the way. Sometimes it continues to trend. If the market is trending strong, then I don't play the news. I just play the direction of the trend, waiting for a pullback. So for instance, and this is not really that strong of a trend, I'll explain why in a moment, but if this were a bit of an uptrend and I was waiting for news, I would simply look to buy on a pullback to what I call demand. And when prices pull back to that demand, hopefully the news drives it into that zone to wipe out the opposing pressure. Okay, I do trade something called supply and demand versus support and resistance. It is definitely different. I do teach this in more detail. I have what's called the E-mini think tank, which again focuses mostly on futures, but the concepts are the same. So I teach that there. I also have some videos on YouTube. If you do a YouTube search under my name and look up something called Chart School, okay, you'll actually find, hopefully you'll find those videos. They better. But yeah, if you just search YouTube or Brandon Wendell Chart School, you'll actually find a couple videos regarding it and kind of talking about what this whole concept is of supply and demand. And those are free to look at. I just kind of share some of those out there with you. And again, if you're interested, you can always message me. I'm on Twitter at TraderBdub. And I think they might have a contact here too. So if you got more questions, obviously you can message me and ask me. Okay. So anyway, if the trend is, if it's not trending, typically what will happen is 15 minutes before the news comes out on the scheduled releases, obviously. If we don't know it was scheduled, it comes out, we had no idea what was going to happen. But again, when we go to this economic calendar, we see, for instance, Great British Pound at 3 in the morning. I will not be personally trading that because I'll be asleep. But if you happen to be open or awake at that time, depending on where you are trading, you can take a look to see why does it matter to traders and what might happen. You can look back at previous numbers to see when they came out and how did it affect you. Do not see what in the chat. Anyway, so, again, you can watch for this at about 3 in the morning. That'd be my time. So that's going to be, I believe, 7 a.m. in the UK, GMT. So -4 right now. Oh, no, I didn't put it in the chat. I just put it in my chat. I just put it on the screen right there. I think I can copy it here. Let me see if I can. Put it in the chat for you. Yeah, I don't have the link for the YouTube videos. I got to search for them. I guess I could find that real quick. Again, you just go to search. And there it is. Reading price, supply and demand trading. That, I believe, is the one. So there I did for you. Copy, paste. And there you go. Like I said, there's a bunch of videos there. So anyway, getting back to this 15-minute before the news, typically, again, not always, price will consolidate a small channel. Okay, again, doesn't always do this, but it often does. And of course, once more, if the spreads are widening during that time frame, you got to account for that. Okay, because there will be increased risk. Remember, when you buy, you're buying from the ask price and selling to the bid. So if those start to widen, you're going to have a lot more risk when you put on your stop losses. You got to account for that based on the type of chart you're using. So right now I'm using the US dollar CAD, but if I did this, I believe it is dot A. Is that it? No, that's not it. I forgot how to get the ask price on this. Or maybe that already is the ask and I go to the bid. Oop. I have to figure it out. I haven't done this in a little while, but there's a way to change the chart so you're looking at either the bid or the ask chart. Okay. So anyway, usually 15 minutes before the news comes out, price will start to consolidate into a little bit of a channel. What happens is I use the 3 5-minute candles before the news. So again, we were looking at the loonie, and the loonie was having news this morning right there at 8:30 a.m. Eastern time. So just before that news came out, I should mark that off so I don't have to keep searching for it. There it is. There is my range that I was just talking about. So I marked the high and the low. There we go. Here's the high. There's the low right there. And I don't know which way it's going to go unless, of course, again, if I'm using crude oil, we got that news on oilprice.com, we can get the API number ahead of the EIA number. So what I'm going to do, depending on the brokers you're trading with, is I put in basically a stop limit order to buy and a stop limit order to sell. So again, it's depending on what you feel is likely to happen. I could put in, let's put in text here. And the reason why you stop limit with the buy, I don't use stop market. Okay, the reason why I don't use stop market is because if the prices move very, very fast, you get filled at a very bad price. So if it moves quickly and I don't get filled, so be it. Because when the stop is triggered, then the limit order goes in. Oh, thanks. I forgot which painting I'm using in my background right now. I think, I can't see it right now. I'm not going to worry about it. Anyway, I think, oh yeah, I'm using one of the paintings I used to have at the trade station office. They took it down. They remodeled. I wanted to get that painting, but oh well. Actually, I have a painting that I did that I use sometimes for background as well. But anyway, need to go back on this. You get me on this sidetrack. Ooh, squirrel. Anyway, so I use a stop limit buy. Again, the stop is usually 1 pip above the range. And then the limit is 3 pips above the range. So I'm willing to buy, but only in a small area outside of the news, or sorry, outside of the 15-minute range before the news comes out. So I'm using those 3 candles before the news and highlighting the high, highlighting the low, and I'll do the same thing on, oops, didn't mean to do that, cancel. Wanted to clone there. Because what I'm going to do on this side, as I mentioned, is a stop limit sell. Stop would be 1 pip below. And the limit is 3 pips below the range. Now, I never trade without my bracket as well. So for each of these orders, there will always be a stop loss. So in this case, I usually put it about 2 to 3 pips below the range. And the target, or basically a limit order, is the next zone. Oops, like that. Now down here, let me get rid of this for a moment. Let's write in the text. Stop loss is 2 to 3 pips above the range, accounting, of course, for the spread as well. And the target, which again is a limit, is going to be the next demand zone. Actually, for the target limit on the top, I should say next supply zone to be correct and exact. And that's it. It's pretty simple. Now, the other thing you can do, it's your choice. Sometimes I get filled on both and it works out pretty well. Okay, or you can decide to use your choice to do separate orders, or create the entries as OCO. Basically, order cancels order, or order cancels other, whatever you want to call it, OCO. And what happens with an OCO is, let's say in this case, the long was triggered for that entry using this information here, the short would automatically be canceled out. And you've got to be very careful here. This is not something that you want to do for the first time with a lot of money or even real money. You might want to do this in simulated mode until you get the hang of it, because it's very easy to make mistakes, obviously. And when the spread widens, as I said, the risk is much more than you would have had if there was no news. So practice this, please, before you put real money at risk. Again, I'm just giving you education. I'm not giving you recommendations. So the OCO, order cancels order work, what happens is, as I said, if let's say right here we broke above and this was triggered, the long was entered, it would cancel this short automatically. So all you would have is you're in, it would put in your target and your stop loss to protect you. And that's it. If you do not use the OCO and this was triggered for the long, this order is totally separate. It still sits there and waits to be entered. And as you can see, when prices finally broke down, you would have been entered on the short as well. So the OCO prevents you from getting filled both sides because it cancels whichever order is not filled. Now, one of the big dangers, and this happens sometimes, is that you get a fake move. You know, if the news was positive, there are times where prices go down because the professionals are trying to play with you. They're trying to trigger some of your orders early to put you in on the wrong side of the news. It just happens. You know, again, these are all the risks that you got to worry about. Actually, I should list some of those risks so we're fully aware. And I can't type today. Number one, spread widens. Okay. And our solution for that is either don't trade or trade smaller size to reduce risk. So that's obviously one of the big risks. Number two, making a mistake on the order. And obviously practice. And practice in simulated mode. Yeah, I'll bring this over here in a little bit. Number three, it makes what's called, I call it a fake out in the wrong direction. There's not a whole lot you can do with that, but one of the things you can do is wait to place the order until just before the news. Because a lot of times that fake move comes a few minutes before the news is released. So to avoid it, sometimes you could do that. Okay, let's see. I don't know if I can fit everything on there, but trying. There you go. So that's kind of the way that I trade pretty much the news on anything. And again, I do this in futures. I can do it in stocks and obviously in Forex, but you do have a little bit of a different dynamic with Forex because of the spreads. In this case, you would have been in on the long. Now, I am playing pure momentum here. So one other thing that I do, I shouldn't say almost never, but I very rarely make it to my targets with this trade. What I'll typically do to get prepared for this is look back in history to see how much of a reaction did we get in the past. And I can identify averages. For instance, again, I trade a lot of futures. So when the crude oil news comes out, often the crude oil futures move 35 ticks whenever that news comes out. That's the average movement. Sometimes it's bigger, sometimes less, but the average has been about 35 ticks. Well, since I know that, I may have a supply or demand zone further than that, but I'll always keep an eye out when prices move 35 ticks, and I'll draw a line there so I know that we might be running out of juice. We might be running out of momentum. So I keep my finger on what they call the oh shit button. Okay. Almost every brokerage has it. It's the exit, or close out button that automatically throws in a market order to close out your position. And it will often cancel your pending orders as well for you. So when I see the momentum dying off, well, like here, you notice we had the news breakout, and obviously this was a large green candle and then started to pull back. Well, when I see that start to pull back, I can get out of the position and try to capture as much of the momentum as possible. Okay. And that, again, just comes down to practice, looking back to see what is the average move. When you get there, just keep an eye on it, see if you start losing that momentum. So how do I set up stops once it goes in the direction? I don't. I set them up before I go in that direction. So right here, when I put in my entry order, I attached a bracket with a stop and a limit, always. So you put in the entire order all together. So let's see here. Do I have it? I'm not connected to a broker right this moment, so let me connect to paper trading for now. I have a couple different brokers I could choose from here. Yeah, paper trading, that's what I wanted. So basically, for instance, if I'm doing a bracket right here, looking at the breakout of 136.910, I can put in buy and stop. Let me see. Is this going to allow me to do a stop with limit? It may not allow me on this one. Again, I wouldn't just do a stop without a limit on it because, again, if it takes off, you can get filled at a very bad price. So I'm just trying to figure out, I don't know how to do this on this one. It's not the platform I usually trade on. But again, what you would do is a stop with limit. So I put the stop price just above, in this case, 136.92. Okay. And I would be using the ask price for this. But then you do a take profit and a stop loss at the same time. So in this case, my stop loss, I'd be putting it under here at about 136.79. So it's just underneath that by 2 or 3 ticks. And the take profit, I would look back to see where my next zone is. Let's say, it's at 137 even. I would never actually get out on the even number, but there you go. No, that's not going to work. It's too close. Let's say it's 138. But yeah, you just simply take profit and stop loss. You always put in those orders with your entry at the same time. In this case, again, I've got the stop here, but I would actually put in a stop with limit. My limit, because I'm entering at 136.92, I would not take a price above, say, 136.95. So my limit would be at 136.95. That way, if it goes beyond that, my limit order sits there. I would probably cancel it if it goes beyond it. I don't get filled, though. That's it. It's pretty simple. Let's see. Cut that back out. Any other questions so far? How do you avoid slippage? The only way to avoid slippage is by using a stop with limit order for your entry. So for instance, again, on this downside, my stop price would be 136.80. And the reason it would be 136.80 for the stop, that would trigger the entry as soon as we break down below this by 1 pip. So at 136.80, effectively what happens is that the limit order goes into sell at 136.78 or 77, however much slippage you're willing to accept. So right here, you see if I have I should probably label these. This would be the stop. Oops, wrong one. That should be limit. There we go. Style. Oh, no, I had the right one. Never mind. Is stop. There we go. And then this would be the limit. So if I'm using a stop with limit, it will trigger the limit order, which basically the limit order says enter, oh, wrong one. I forget where it is, the rectangle. I forget where all my tools are here now. That's right here. So basically, once the prices go, whoops. Once the prices go below that red line, I'm basically putting in a limit order to sell anywhere in that range. Right? That's it. And if it goes beyond that range, I will not sell anymore because it's a limit order that goes in. But I have to remember to cancel the order so that way if it comes back, it doesn't get me in. I only want that initial thrust, the reaction. You get, basically when the news comes out, you usually get a three-prong move, okay? And by the way, I do this on a 5-minute chart, very small time frame because it reduces the risk, okay? No, I use sell, stop, limit. Always stop, limit for the entry. And what normally happens when news comes out, I said you get a three-prong move. You get this knee-jerk reaction. You usually get a correction. Sometimes the correction comes all the way back to the breakout point. And then you typically get continuation as the trend picks up and just keeps going. Doesn't always, but usually you get that three-prong move where initially it's a knee-jerk reaction. Let me delete these so they're not in the way right now. And that's what I'm trying to capture, is that knee-jerk reaction. You ever seen a stop limit? There's plenty of stop limit orders in places. Just depends on the platform you're trading on. Yeah, you don't want to use a stop market order. You want to use stop limit. It's combining a limit with a stop as a trigger, that's all. And if you don't have it, don't do this. Because again, if you try to do stop market, if that knee-jerk reaction takes you very far away from your entry point, you could get filled right here just before prices reverse. So definitely only do this if you have a stop limit capability. Okay, because if you try to put in a market order, again, it could blast right through that. Or you could wait for the news and try to put in your limit order as it's breaking out, but that's going to take a faster reaction than you might be able to do human-wise. So anyway, like I said, we have a correction where things pull back, and then continuation. Where the trend keeps going. So it's also possible, if you want to be a little bit safer, you wait for the knee-jerk reaction, wait for the correction. And by the way, this is a second part of the trade as possible. If the knee-jerk reaction takes you into a zone, for instance, here we have drop, base, rally, you can actually do what's called a fade on the correction. Basically, it's no more than just simply buying or selling if you're on the upside. You buy the demand zone and target a return to the breakout. It's usually a little bit safer to trade that. It's after the knee-jerk reaction. You're just trying to catch the move back to the breakout point. That's all. Is it a sell limit? No, it's not a sell limit. It's a stop limit order. There's orders called stop limits that combine the power of the stop that triggers an entry or triggers basically placing the order with the limit. So if your platform doesn't have that, you got to be careful. Again, you don't want to use a stop market order. So no, I'm not waiting for this 5-minute candle to print. I'm getting in as soon as that news comes out, typically on the breakout. Okay. So again, you got fade the correction. That's the other possibility. Or if we had the knee-jerk reaction to the upside, then what'll happen is you can sell at the supply, waiting for it to come back to the breakout point. Now, of course, that can have a little bit of risk because with the news, it could carry beyond the zone. So there's definitely a risk in that as well, that the momentum is so strong it goes beyond your zone. It doesn't always, but it can. So the safest way to trade this would be to wait for the continuation. After the correction, if it comes back to the breakout area, then you simply jump on board with the trend after the news has been released. So let's see, this doesn't have the best example of it, so let me see if I can find another one here from previous news. Let's go back. The calendar. Let's go last week. And I think we had a news release minutes. Maybe we check retail sales here. This was 8:30 on Wednesday the 15th. So go to euro dollar, 15th. There we are on the 15th. And let me check what time did that come out? Retail sales 8:30 in the morning. That's typical. So 16th, 8:30, you can kind of see where the news came out, right? And this one might have tried to trick you in this case. So here, where's the 8:30 candle? Right there it is. Okay. And this is one where it would have been difficult because you can see we're not really basing, are we? We got a really wide range here in the last three candles before the news comes out. 8:15, 8:20, 8:25. It's kind of wide here. So that would have been difficult to use all three candles. So I probably wouldn't have placed the trade. But if you did, you can possibly narrow it down sometimes to the last two. Again, placing a buy, stop limit to buy, stop limit to sell. And what happened in this case, you can see it broke down. Didn't really go very far, did it? It went back to the origin of this little buying pressure here and pulled right back. So you didn't even get much of a profit at all in this case. That's why you got to make sure you're looking at news releases that are really impactful. Just because it shows the orangish or reddish color there doesn't necessarily mean there's going to be that big of a reaction. You go back to look at history and see how did price really react. And you can see it came back, actually overshot the range, and then dropped very quickly. So you definitely have to be careful there. Let's see what the Kiwi was. 1745 on the same day. Going back. Wednesday the 15th. Oops, wrong one. There it is. So just before the news comes out, again, waiting for that sideways consolidation. There it is. 35. Okay, obviously you can see where the news came out. So once again, you would have the range, and this was really tight, possibly because, again, that's during that slow period of time where the markets don't move much. So maybe you go a little wider, or you keep the tight range. Either way, again, what I'd be looking for here is stop, limit, buy, again with the bracket, and of course, always with a stop and the target to get out, and then stop, limit, sell underneath. Of course, with the stop loss above and the target at the next zone. So if I was looking for those targets and the stops, let's see, that's already been used. Try to see if there's a target here anywhere. Maybe this. As far as on the downside, let's go back here. Might be okay as a target. It's kind of choppy. I actually probably wouldn't use that one. I should go to one that I would use, which is right here. That's much better. Okay, so now we go back to my news release. I won't go too far here. 15th, late in the day. Getting closer, and here we are. So there's the news release that we're getting ready for. We got the stop limit buy, stop limit sell ready to go in either direction. I have my targets. I would have, by the way, I don't get out at the target. I get out prior to the target. Everybody's trying to get out at the target. So we want to get out ahead of it. So that way we're not competing to exit. Yeah, we give up a little bit of profit, but we have an easier time exiting the trade. So my targets would actually be just before. And of course, I got stop losses on the opposite side of the range. There's the news breakout. And there's the target being hit. You can see there was a little bit of momentum loss. I might have exited here because that large red candle started pulling back a little bit. So I might have had the manual exit. I don't always get to my targets, but if you did, it worked. It's a pretty good move. So it doesn't always work out as beautifully as this one does. I wish it would, but we don't live in that world. We live in the real world where sometimes it works, sometimes it doesn't. But be careful again, if you're trying to do something like this, make sure you practice without putting real money at risk first. And if you have more questions about it, obviously you can catch me, as I said, online. Actually, I could probably get my email address. You can always hit me up there as well if you got more questions. So I'll open the floor up again to questions if anybody has any. I think we were looking at the dollar CAD with the notes there. Yeah. So if you got questions regarding any of this, please let me know. I want to thank everybody for being here. There's so much data on this. I forgot. Just typed in so many different notes. So anyway, if you want to do some screenshots, you can let me, you can go ahead and do that as well. Would have gotten slippage on this one on the Kiwi? I don't know. There's no way of knowing unless you actually place the trade. Because it moves very fast, it is possible. But remember, you're only going to accept a little bit of slippage based on the limit order you place. So the only slippage you will have is between your stop and your limit price. So the stop is 1 pip either outside the above or below the range. The limit is 3 pips outside the range. So the maximum slippage you should have is 3 pips. Now, you may have to adjust that a little bit because of the spread. So you may have to be willing to accept 5 to 8 pips perhaps, depending on how much of the spread widening happens. And that's something you're going to have to take case by case when it comes to the securities. If you trade something like the Beast, pound yen, that's going to have much more volatility. If you trade something that is less volatile, you'll have a tighter spread typically. So you got to take that into account. But by placing a stop with limit for your entry, you protect yourself from having unlimited slippage. Yeah, you're stating how much slippage you're willing to take. Sounds like my neighbors are doing construction. Okay, any other questions? Which broker do I use? I have a lot of different brokers that I use for different things. For my Forex, I've got a couple. I don't know if I'm supposed to say them or not, but I have accounts with Oanda. I've used Saxo Bank, a few others. You just got to find one that you feel comfortable with and use them. Any other questions? Kind of quiet. Hear the crickets now? Well, we're pretty much out of time anyway. So like I said, if you got any questions, you can hit me up on Twitter. I'm at TraderBDub on Twitter. And I gave you my email address. I'll type it in again, I guess. Just my name, .cmt@gmail.com. Probably the best way to get a hold of me. All right. Is secondary entry on the pullback after the news release? Yeah. So right here, you can get that fade trade back to the breakout at a zone, or you can wait for it to come back and then trade the continuation, which typically happens. Okay. All right. Well, again, I want to thank everybody for being here. I'm going to go ahead and cut out. My dog is barking. Needs to take them out. If you got more questions, obviously you got ways to contact me. I hope to see you again. And until next time, everybody trade safe, trade well. Take care.